All right, Vikash Jain joins us, represents CLSA. Let's understand the house view of CLSA. What are they advising their clients, and how exactly one should fasten their seat belts to navigate the volatility. Vikash, good morning. Thank you for joining us. Let me first start with a very basic question. What is your market assessment in the short term and in the medium term?
Okay. So, I mean, if we were to be more specific on what you mean by medium term, that would help. But clearly, from a slightly longer term perspective, we continue to like the India story. So that's not really where the problem is. Our only complaint with the story is more to do with stock markets running ahead of themselves to an extent. And otherwise, if you were to see whether you were to look at the various cycles, whether it is a credit cycle in India, the investment cycle, the real estate cycle, all of those things, none of that is in an alarming spot at all. I mean, they're just kind of just starting to pick up. So the worry that we have is more shorter term around stock markets running ahead of themselves, a need for them to kind of stop and catch a breath. So I would say that's how we would divide our medium term and short term opinion. Continue to be positive on the medium term side of things. There are various reasons to believe that Indian market would gain significance in the global investing scene over the coming years. So that's not something that we are, that we are concerned about. However, they seem to have got a little impatient in terms of expecting immediate returns, and there could be some catching up on that, which could, even in multi-year bull markets, you do have periods of periods of corrections or periods of consolidation. We could be getting into one of those, is how we think about it. So shorter term, a bit more cautious. Medium term, continue to be bullish.
I'd like to draw everyone's attention to your downgrade and recommendation cycle. Big downgrades in CLSA recommendation, IT banks. Now, bank, IT, we understand, global uncertainty, AI, everybody is aware of that fact. But banks is where the hopes are high, banks is where the cycle is strong, banks is where the credit offtake is high and NPAs are low. Why have you downgraded the outlook on banks?
No. So we've actually, so the note says that there have been big downgrades during the quarter. They've not been in banks. We in fact like banks a lot. What we are saying is that this quarterly reporting season, which is the last 6 weeks roughly, has been a period where we have seen 18 stocks of, close to 120 or so that we wrote on during the quarter. 18 of them getting downgraded. That's like, almost 17% of the stocks we covered, we downgraded, only 5 stocks getting upgraded. This was at a point where this quarter otherwise appeared to be, results were clearly ahead of our expectations in terms of overall universe. Results were almost 6-7 percentage points higher YOY growth than what we started with expectations for the quarter. Simply put, despite results being ahead, some of the stocks seem to have run well ahead of themselves, and analysts are feeling quite uncomfortable. That's why we've been forced to downgrade, which is in a way what I was just saying about the market in general as well, that possibly we are at a point where, market needs to kind of stop and catch a breath. In terms of banks and IT, yes, IT, there was a kind of a shift in coverage, and our new analyst has, on a relative basis, has very few buys in the sector, and that's how we are positioned even from our strategy portfolio as well. We have a reasonably large underweight on IT and a pretty big overweight on banks. Banks is in fact one space within an otherwise exuberant market where we believe valuations are pretty interesting and attractive. If you were to believe in the medium-term story of India, then banks will need to kind of, banks will possibly be closely linked to that story. And to play that medium-term story, I would say even right now where valuations are for banks in general, clearly they're not, that's not a bad entry point at all into these stocks in a market which is otherwise looking stretched in most other spaces.
Hi, morning. Wanted to get in your thoughts on the PSU space as well, and I'm going to exclude banks out of that. Ex-banks, what's the concern right now on the street? Is it more a problem of growth visibility, or do you think it's just purely on the basis of valuation that everyone's getting a little, edgy around the run-up already, which has happened in PSUs?
See, I think even if you exclude banks, there are portions of the PSU basket, whether it is utilities or commodity stocks, you can't really pass them on as India stories and put them into any kind of multiple that you would like, because they have very clear peers. Even banks or other financials would have peers on the private side. I would say the PSU rally, and well deserved, started sometime in the second half of last year, where these stocks were still quite cheap. However, with the very strong rally that we have seen, I think the PSU index might be up a good 50-60% in the last 3-4 months. Uh, they are no more really cheap. If you were to look at, uh, it's time where this is something which happens with all kinds of rallies, whether it is sectoral, thematic rallies, or market rallies in the market in general. Initial part, when everything's quite depressed, sentiment turns, that tide kind of lifts all boats. And once we are at a higher level, is the point where you need to start separating out the men from the boys. I think we are possibly reaching that matured level for the PSU rally sometime, uh, you know, sometime now, where we need to get a bit more selective, because the fact is that not everything can classify as India's story, which can command any kind of a higher multiple. A lot of them have very clear peers, and despite the fact that all the noises coming out from the government is clearly very supportive on the way they look at PSUs. After this initial rally, a lot of that juice is now not on the table anymore.
Selective when it comes to PSUs. But Vikash, let's talk about identifying some emerging opportunities down the line. Would it be perhaps China plus one, digitization? What are some of the companies or maybe trends that you have seen within new age tech companies that they have adopted that are big opportunities?
Yeah, so I think for us in India, the clear opportunity comes from, also there are certain things which are pretty clear from a government policy making side. Uh, Government has been, particularly more so emphatically in their second term, been extremely investment focused. So that to us is something which is a multi-year theme. In terms of the investment side of things, the capex linked stocks is something which is, may not sound very fancy new age fan kind of stuff, or the Max 7 as the new name is, kind of stuff, but still something which we believe has more legs. Uh, Yes, so that is the investment, and the capex side of things is a story which clearly has more legs, and that is something that we would want to continue focusing on. So that is the first part of the story. The other part is the Indian market in general. We still get into calls with people, global fund managers, who are not involved in India like they should be. And there are, quite a few reasons that they bring out. A lot of them are legacy reasons. The fact is that this market is now very clearly, on most parameters, one of the best large and liquid stock pickers market, which is yet to be recognized very well. I mean, that is something which is a big re-rating story for India in general. I still, if you see, still the overall ownership of foreigners of the Indian market is near decadal lows. That's because, of course, a lot of domestic money has come in. But if the economy is expected to grow the way a lot of us really expect, and the Indian market is, if like for example, if you were to look at the number of liquid stocks that are available in the Indian markets, that's just puts it as the highest after the top three markets, that is the US, China, and Japan. And in the next 5 years, as Indian economy possibly takes over, the Japanese economy becomes the third biggest economy. Even our market is going to be like that. And within that universe, if you were to look at trying to get well well managed, well governed bottom up stock picks, India would stand up right up there, possibly starting to get close to next to the US. I think that kind of a change in market dynamic is not yet fully appreciated by the market. A part of it, why it has not got fully appreciated, is we've been in a more like a DM or US kind of a bull market in the last 10-12 years. As that transforms into an EM bull market, as possibly over the next few years, we see rates getting cut, and a kind of a cool off in rates as well as dollar, leading to a broader EM rally. this time the big beneficiary of that EM rally will be India. So from a flows perspective, that is the big re-rating story that global fund managers need to kind of track. Right now also there is a lot of room for that to kind of go higher.
Okay. Now, Vikas, let's understand the liquidity setup. In this kind of an market appeal, FIs are unlikely to be big sellers, HNIs are unlikely to be big sellers, and you got retail which is coming in on a daily basis and mutual funds which are getting 15 to 18,000 crore on a monthly basis. When funds get allocation, they have to buy. They're not going to be keeping money in a liquid fund, they will have to buy. That's the mandate. So if 18, 19,000 crore comes on a monthly basis, what kind of impact do you think this will have on underlying asset prices?
See, this is a popular kind of a question that, okay, what is the thing which could go wrong with the market? See, 18, 19,000 crore, let's just put things into perspective, is just about $2 billion for a $4 trillion market. So just a $2-3 billion of inflows will not be large enough to take markets much higher. Last year, the kind of rally that we had was because it was a year when both FIIs and domestics were buying. The year before, where there was significant domestic buying but large FII selling, that is in 2022, Nifty did not really do much at all. It was up 3-4%, I think. So from that perspective, just a couple of $1 billion of domestic inflows is not good enough. It has to have a larger number for much bigger returns to play out. For example, January, we saw multi-month record in terms of domestic mutual fund inflows. But at the same point of time, this was offset by FII selling to the tune of 3 billion plus. And that's why January was a flat month for Nifty. It did not do anything. So I think although those numbers appear to be much higher as compared to history, what we need to appreciate is the fact that our market size has also become much higher. So just a couple of $1 billion is, of course, that's good downside support and to offset any kind of negativity from FIIs. But incrementally, we need further hand-holding for markets to go do much more from there.
From a market standpoint, the election cycle where everybody is convinced that it's going to be continuity, can we say it's a no event? Just don't think about it, just don't talk about it?
I would think so. In fact, to the contrary, a lot of people do bring out a point that elections have generally been great years for the market. But if you were to compare how we are going into this elections versus the last 4 or 5 elections, they generally, what is good about exciting about elections is change and surprise. I think the surprise and the change element for this elections is by far the least we have had as compared to any of the other elections that we have seen, starting say even 99 or 2004 and going back that much. So from that perspective, yes, maybe finally we need to get that good event out before a more decisive view move on the market. But clearly, the surprise of that element of that election is also gone. Also, the 2 other reasons for it, we have perhaps celebrated a positive election outcome already twice at least. Once the state election results in early December, and secondly, also the changes that we saw in Bihar more recently. So we already celebrated a very strong election outcome a couple of times, and valuations are not nervous at all going into the event. I think maybe what the markets are expected or hopefully looking for is a clearer outlook, which will come more not in the election, but the budget which follows the election. So sometime between May and July is where we could have a more significant event. As long as we believe that there are no, completely difficult to predict negative surprises in the election.
To your mind, Vikas, final question, the chances that there is this risk which nobody says no to, and real conservative, long only guys would say, okay, we know which way the wind is blowing, but we still want to wait and we want to come back after May once the mandate is clear. Do you see that this thought turning into a reality and a lot of flows could actually come post the election?
See, I have not heard any long only guys also really being nervous about elections at all. So it's more or less a conclusion which has been accepted that there will be continuity. A third term for the ongoing government is what most is where market expectation is very clear. So that by itself is not going to drive big flows. What might happen is elections and then the budget is we do see a lot of companies in pretty good state in terms of their balance sheet. A clarity of policy making over the next 5 years will perhaps allow them to get a bit more aggressive in terms of their investment plans. That is more from the corporate side, which might lead to more excitement on some of these stocks. That's a different thought process. But otherwise, on its own, elections driving inflows on the positive side is something which I think is already been happening. So there's not likely to be much more positive surprise on that, in my opinion.
Sense. Vikash, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thanks for having me.